Markets are turning cautious as central banks pull back on rate cut hopes, tech stock wobble, and also inflation pressures lingering at home and abroad. To break it down, we're joined by Kyle Rodder from Capital.com. Good to see you. What a week.
Yeah, it's been one of the biggest weeks of the year, certainly the biggest week for the quarter. So extraordinary volatility. It's been a very busy week for investors.
The Fed, there have been a lot of expectations. When we spoke last week, we were talking about rate cuts galore, but they're walking it back.
Yeah, they were probably not talking up rate cuts as aggressively as the markets were pricing them in the past. And I think that was probably the risk going into things. And I think we have spoken about it in the past, that the curve was implying very aggressive rate cuts going into next year, pretty much focusing on some of the deterioration happening in the labour market, but neglecting effectively that inflation remains with a 3 in front of it, and at least for now moving away from target because of the impact of tariffs. So Powell's language is effectively, don't bank on a cut in December. That's not necessarily to say that they're changing their balance of risks or the assessment of the balance of risks to the economy, but they want optionality because they don't want to be sort of backed into the corner where they have to pull the rug from underneath the markets in 6 weeks' time by potentially not cutting rates because inflation's a bit too hot. So really they want to try and temper the market's enthusiasm for cuts. And we also saw a real high degree of division on the Fed too. So it's a very unclear, divided, sort of ambivalent time for the central bank, and I think that's one of the reasons why we saw a big pullback in equities last night, is that that's now being discounted.
Yes, markets aren't particularly happy about that. I mean, on the one hand, you've got what appears to be some sort of trade deal between China and the United States. What does it tell us about what the Fed's actually looking for? Is it still that key inflation figure?
Yeah, well, again, it's about trying to get a clearer sense of the balance of risks. And the problem is that, we do have signs of deterioration in the labour market, and there's not a great sense of why that's happening, not just because we haven't had official data for a few weeks now. So the Fed is to some extent flying blind. Of course, they've got teams of economists to try and keep a finger on the pulse of the economy anyway. So they have a sense, but they're not getting the data coming through. And then with the labour market, is it because of genuine slowdown in the US economy? Well, GDP growth is pretty strong, so that sort of contradicts that. Is it because of artificial intelligence that businesses aren't employing because they're rolling out, these productivity gains from technology? That's a different story entirely. Or is it even an immigration thing where we've got this big supply shock from changing immigration policies that's just lowering the potential growth rate for employment in the US economy? They don't have a clear picture of that, and all of that has different implications for how they approach policy. And then again, on the other side of things, they have this question of whether the lift in inflation they've seen lately is for temporary reasons because of tariffs, or things are just very sticky as they were before tariffs were implemented. So they don't have a good picture of things, and this is why they don't want to overcommit to one side of their mandate or the other. They want that optionality. It's
interesting because obviously markets like to see rate cuts, and everyone likes to see rate cuts except for savers, obviously. Do you think that it's about trying to temper that optimism in the market, which we have been talking and concerned that there could be some sort of a bubble here, and that if they can temper that with, I guess, signalling that there aren't going to be massive changes to rates over the coming quarter, that maybe they can temper that excitement?
I think that is definitely a part of it. And again, it's another thing sort of in the abstract we've discussed in the past, which is to say that, I think it was Ben Bernanke that said that 98% or something of that nature of central banking is just language or words. And that sounds superficial at one point, from one point of view, but what he really means is that what the Fed can do with its language is guide rates markets in the direction that it wants to head. And in doing so, even before cutting the federal funds rate, it can ease financial conditions and stimulate economic activity, certainly stimulate activity in financial markets. And so I think a part of why Powell wanted to back away from things is that the markets were pricing in basically that policy would be in accommodative territory into next year. That's already having an impact on economic growth. That's already having an impact potentially on inflation. And he wants to go, okay, well, not only do we want to be able to keep all our options on the table, we don't want to make our life more difficult by effectively adding stimulus to the economy by adding to these rate expectations. So that's definitely the case, that they want to take a little bit of the, to borrow language from Greenspan, pull the punch bowl away from the markets a little bit, so we don't get a little bit too intoxicated on the expectations of rate cuts.
Yes, very much so. That's why they never really say anything when you listen to these Fed Reserve chairs. They're so careful about even tone, right, about what they say. Let's talk about big tech. It's been a big week, up and down. Nvidia, massive results. Meta, not so much. What's going on?
I would say that at a very high level, it reflects again troubles that businesses or these companies have in exceeding very high expectations, or the challenge that comes with that. So Meta's results, on an underlying basis, we're very good. There's still questions across the board about the level of capex going into artificial intelligence. And if
But they've pulled back. They've started firing people from that division over the past couple of weeks,
yeah,
right?
headcount, but physical infrastructure is still firing. So they still want to build data centers and the capacity to be able to try and obviously power this stuff forward. And this is probably the most cogent argument I've heard about bubbles around here, is that maybe we're not so much in a financial bubble, but it could be an industrial bubble where physical resources are being misallocated. And the problem is, obviously, if you spend a lot of money on physical resources and the growth isn't there to justify a good return on investment, stock prices have to reflect that. So the results from Meta was really just because of a tax bill, and that was, again, a big hit to their earnings, about $15 billion, and catalysed that big sell-off that we saw yesterday, about 10%, I think, by the end of trade. But all the other earnings have been reasonably mixed. It has to be said, Apple and Amazon this morning were actually really good. It looks like the NASDAQ might jump after the sell-off last night. But it just sort of goes to show that these companies are, again, dealing with very high expectations. Any kind of miss or disappointment is being heavily punished. And it's sort of a question whether, there will continue to be this earnings momentum in the future to be able to continue to justify these juicy valuations.
It was interesting seeing an interview on CNBC with Microsoft's founder, who was talking about how AI really is a massive thing. And when you compare it to the bubble and concerns about the tech bubble that happened at the start of the century, it isn't similar because it really is the beginning of something new. And the trouble that a lot of these companies are now having is that if they don't spend the money, they could become the also-rans, and that's who fell out of the tech bubble.
Yeah, certainly. And there is a distinction because obviously a lot of the companies that ran up in the tech bubble, well, it was much more broad-based and was a lot of companies that were making profits, so there was much more hopes and dreams sort of elements to being, in share prices. And I think this is where it sort of comes back to the question of this a financial bubble? Well, perhaps not, because these companies, although very richly valued, are actually just printing money. I mean, Alphabet's results yesterday was a great example, $100 billion for the quarter, first time in history, record revenues, a lot of that driven by growth in these sort of AI sectors and what have you, all those parts of the business are sensitive to it. But the question is what will AI do to the economy, and what are the productivity gains that it will generate? And is that being reflected in share prices adequately or not? My view as a sort of a layperson when it comes to the tech stuff is that either it's a big productivity driver because it helps workers enhance what they do already, makes us just more productive as individuals. With valuations where they are, that seems to be a little bit more expensive than what's, perhaps the reality of how this could benefit the economy from a productive standpoint. The really big development will come if someone can crack AGI, artificial general intelligence, but that comes with bigger implications for investors, because that kind of says that this technology won't be a thing that enhances the productivity of workers. It'll be something that displaces workers entirely, which is great for owners of capital, but it's not great for workers and other parts of the economy, and you might get this K-shape sort of development. So this is where things are very sort of finely balanced. Will AI continue to develop along the line that continues to justify the sort of growth that we're seeing at the moment, or will it not? And will it be still very interesting and spectacular, but share prices have to reflect the fact that it's actually not as revolutionary as we thought.
Yes, well, Henry Ford, of course, with the production line for Ford motor cars, said it's all very well for productivity, but you've got to have the workers to be able to afford to buy the cars. Yeah. The Magnificent Seven, are investors still happy?
Yes, overall, but again, there are just sort of questions about whether we've come a little bit too far too fast. And I think as well there is signs of a bit of irrational exuberance in the markets in general, certainly the last few weeks. And so it makes you think that maybe, you're seeing that in crypto again, you're seeing that in meme stocks. Beyond Meat, a company, I'm a plant-based dude, but Beyond Meat shouldn't be up at 100%, 1,000% in the space of a month. No one's buying it, it's a meme stock. We're seeing all this kind of excess in the markets. Although these kind of companies, the Magnificent Seven companies, are clearly not, driven by speculation entirely, there's a little bit of that sprinkled on top. And so it makes you think that maybe some heat needs to come out of this market, because it's being very much driven by a bit of mania. So that's my concern at the moment, that things have gotten a little bit too hot. And again, going back to your question about Powell, maybe he's seeing signs of that excess as well.
Yes, and then there's a whole question about Australia as well, with our inflation numbers and situation there. Always appreciate your insights. We'll talk to you again soon.
Thanks.